I feel like I'm repeating myself. Gold hits a new record, $3,823.40 per ounce. The drama of the number, the drama of price. As we continue forward here, let's take a look if silver went along for the ride. Indeed it did. $44.50 per ounce, just closing in on the $50 an ounce record here. So exciting times. Meanwhile, life goes on in the copper market, $4.58 per pound, according to CNBC here. So very exciting times. Now, it is worth mentioning, platinum and palladium. Palladium is up 2%, up to $1,237.50 per ounce. Platinum is up 1.6%. Whereas gold is up 1.2% and silver is up 0.6%. So the rally continues in gold. Hello and welcome to the Northern Miner Podcast. My name's Adrian Pocobelli. In what some people are calling a commodities supercycle, when you take a step back, it is starting to feel that way, isn't it? And the timing couldn't be better. For Cam Currie, Senior Investment Advisor at Canaccord Genuity, who I just interviewed a couple of days ago on the gold stocks and the silver stocks, and really his favorite areas of the metals markets. Very interesting discussion. He's been quite prescient on where this gold price has gone and the opportunity in the precious metals stocks, so definitely deserves a kudos there. Now, here is the headline on mining.com yesterday. Gold price ascends to new high, silver price at 14-year best. Interest rate cuts are seen as the main factor here. As it says here, with Monday's move, gold has now risen by more than 41% in 2025. Central bank purchases and strong investment demand remain the key drivers of this rally, which could be traced back as far as 2022 when the Russia-Ukraine war broke out. So quite a few factors being listed. Central banks, geopolitics, interest rate cuts, investment demand. And as I discussed with Cam, a bit of a safety trade to a certain degree. This question for those that have done fantastic in this stock market with these elevated levels, with increasing talk of a quote-unquote bubble. Jeffrey Christian has mentioned in the past this notion of diversification. As I mentioned to Cam, where are you going to go to preserve your assets should there be a drawdown in the market? Where are you going to go? Are you going to go in the bond market? The US dollar has not performed exceedingly well. Or do you want to go in the European bond market? European economy is looking kind of tenuous, and the euro has already rallied. So do you think the euro is going to continue to rally? As Cam calls it, a tectonic shift in the markets. This new portfolio allocation we're starting to hear from money managers. We discussed it last week with Ray Dalio saying 10 to 15% gold in a portfolio is not a bad idea, is actually a good idea. So interesting times. We discuss all that. So a great discussion there with a great guest. Also, we have Major Drilling for this week's Spotlight, our sponsor for this week's episode. And they're up to all sorts of initiatives and partnerships. So we're going to hear from Major Drilling this episode after our introduction here. Now, there is a ton to get through. So the rare earths, once again, have risen to the top. And we have some pretty wild stories coming up here. At the end of the introduction, you start to wonder if these stories are true. From the South China Morning Post, which I looked up, I had to double check the credibility. It is a credible news source. It is out of Hong Kong. It's not seen as necessarily completely independent, but as far as Chinese media is concerned, it is considered one of, if not the most, independent media out of the country. And I tell you, they have some pretty interesting stories, and we can make of them whatever we want. So that is coming up. You don't want to miss that. It's tempting to start, but we have actually bigger stories in the rare earths. We have a massive update here from the New York Times and from all the players involved. So let's get into it. So to start us off, China's rare earth product exports surged to highest since 2012. It's by a staff writer at mining.com. And this is going to be in contrast to really many of the other stories we're going to see here. China's exports of rare earth products, and I think the key word there is products, jumped to a near record 7,338 tons in August, marking the highest monthly volume since 2012, according to customs data cited by Bloomberg on Friday. The data comes right before a scheduled phone call between Chinese President Xi Jinping and U.S. President Donald Trump, during which they are expected to discuss trade and critical minerals. So it kind of looks like everything is well. But I think we're back to the word product, because listen to this, scrolling down. However, the recovery may also indicate that exporters were only catching up on delayed magnet orders from the earlier months. Customs data earlier showed that Chinese exports of just rare earth minerals fell 3.4% to 5,792 tons during the month. So we are dealing with words here, which can be ambiguous, but as far as I understand those words, it sounds to me like magnets that are produced in China using rare earths are now being exported at volumes we haven't seen since 2012. But the minerals themselves, if you want to start doing things with them, that's actually down 3.4% during the month. And it continues, despite the surge in Chinese exports, end users of rare earth magnets in Europe remain undersupplied, with many forced to halt production, according to Bloomberg. If you were to be speculative about it, if you're China and let's say you didn't want the West to have rare earths, I wonder if China exports to BYD in Mexico, for example, if they export a bunch of magnets, that's probably considered, I'm guessing, an export out of China. And I am just thinking out loud here. But what does it mean if Europe remains undersupplied here? The EU Chamber of Commerce in China said Thursday that companies incurred 7 production stoppages in August because of the shortfalls. And an additional 46 are expected this month, 46 work stoppages, though it did not specify the scale or nature of the affected facilities. A further 10 stoppages are expected by December, in addition to those in August and September, the group added. Quote, "We are seeing things moving, but they are moving extremely, extremely slowly." Carlo D'Andrea, the Chamber's vice president and chair of its Shanghai chapter, said at a press briefing. He called the supply bottleneck the biggest issue currently facing the group's members. And in Europe, you can imagine they have quite a few issues that they are dealing with. That is quite something. The information on potential shutdowns comes from 22 firms that have sought the Chamber's help in getting approval for a total of 141 urgent applications for exports from China, Bloomberg reported. Quote, "China's imposition of export controls on rare earths in April 2025 exemplifies how the U.S.-China trade war can have significant spillover effects on global trade, critically impacting European companies' supply chains," the EU Chamber said in a report earlier this week. The EU warning contrasts with remarks made earlier this week by U.S. Trade Representative Jameson Greer, who said supplies to his country had, quote, "bounced back up significantly." So, mixed stories here. Then we got a story from Bloomberg this morning. China rare earths issue remains unresolved, U.S. lawmaker says. This is September 23rd. The U.S.-China dispute over Beijing's control of rare earth supplies has yet to be resolved, the head of a visiting U.S. congressional delegation said after meeting Chinese officials, signaling a key irritant persists in bilateral relations. Representative Adam Smith described continuing challenges on the matter in a press briefing on Tuesday in the Chinese capital, where he's leading the first official visit by U.S. House lawmakers since 2019, as relations steady before a potential meeting between the country's presidents. Quote, "I don't think we resolved the rare earth question," Smith said, without specifying what the sticking points are. Quote, "I think that still needs to be worked on." So, not super clear here exactly what is happening. Now, we do have other stories here. This EU shutdown story was reported by Reuters last week. EU firms brace for more shutdowns due to China rare earth controls despite summit promise. It's by Mei Chu at Reuters. And scrolling down, during a July summit between European Commission President Ursula von der Leyen and Chinese President Xi Jinping, China agreed to fast-track licenses for critical raw materials for European companies, although it fell short of EU's wish for China to grant licenses for a longer period or to scrap them for exports to the bloc. License approvals have slowed just 2 months after the summit, and the chamber said it was starting to receive an increase in complaints and requests for help from its members. Quote, "I think it's fair to say we have not seen a material shift since the summit," Jens Eskelund, the chamber's president, said. And he continued, quote, "We have a number of members who are right now suffering losses because of these bottlenecks." So all sorts of headlines coming up here. EU energy chief heads to Greenland amid scramble for Arctic critical minerals. This by Magnus Lund Nielsen at Euractiv. Energy Commissioner Dan Jorgensen is set to touch down in Greenland on Tuesday, the latest senior official to visit the vast Arctic island that has found itself at the center of a global scramble for critical raw materials. So it continues there. Now another related headline. This, again, indirect, but I think worth mentioning here as we put the pieces of the puzzle of what is actually happening in our great world today. This is from The Atlantic last week. The U.S. is quietly pausing some arms sales to Europe. As part of the America First agenda, the Department of Defense is stockpiling weapons. And that is September 19th. And here are just a couple of lines. The first clue that something had changed in the U.S. approach to selling military equipment to Europe came as Denmark neared a decision on the purchase of a multi-billion-dollar air defense system. For weeks, American and French negotiators had aggressively pursued the deal. But as the deadline approached, the Pentagon suddenly lost interest. Quote, "We couldn't understand why," a contractor who had been tracking the discussions told me. Quote, "It seemed like a no-brainer, but they just weren't into it." Then on a call earlier this month with the State Department, Undersecretary of Defense for Policy Elbridge Colby said that he didn't believe in the value of certain foreign military sales, according to 2 administration officials with knowledge of the discussion. He added that he didn't like the idea of selling Patriots, which can intercept incoming missiles, to Denmark because they are in short supply and should be reserved for the United States to use as needed. The officials, like others I talked with, spoke on the condition of anonymity because they were not authorized to discuss this sensitive and evolving situation. Now, why is there a shortage? Is that simply because a lot have been used, or is that because they can't make any? Or is it both? And continuing on, and we haven't even gotten to the New York Times story here. Another headline, this is Reuters on September 18th via mining.com. U.S. lawmaker wants Trump to restrict Chinese flights over rare earths access. The chair of a U.S. House of Representatives Committee on China on Thursday called on the Trump administration to restrict or suspend Chinese airline landing rights in the U.S. unless Beijing restores full access to rare earths and magnets. Representative John Molinar, a Republican, also said the U.S. should review export control policies governing the sale of commercial aircraft, parts, and maintenance services to China. Quote, "These steps would send a clear message to Beijing that it cannot choke off critical supplies to our defense industries without consequences to its own strategic sectors," Molinar said. What can we gather so far here? The rare earths aren't flowing in the way that the West would like, and it is causing pressure points, pain, so to speak. So, very interesting there. Then we have this big story from the New York Times. The race is on to make rare earth magnets outside China. So, something we've been discussing here, one of the big questions, if not the biggest question, of the rare earths discussion is, how fast can the West put together their rare earth processing facilities, or how fast can they produce these minerals for themselves, for their supply chain, for their militaries? This is the $64 trillion question, one could argue. And it's quite interesting. In this piece, what they mention is the world is trying to put together alternatives, but really it's showing how far ahead China is. And this is by Keith Bradsher at the New York Times on September 19th. Scrolling down, but the scramble since April has served only to underline the lead that China has after 3 decades of heavy investment, and how hard it will be for the rest of the world to catch up quickly. China has used its chokehold on rare earth magnet supplies to gain leverage in trade negotiations with President Trump and with the European Union. Since the initial cutoff, Beijing has allowed some rare earth exports, but now keeps tighter reins on them. As a result, Mr. Trump has been more cautious about raising tariffs on China than on countries like India and Brazil, which were not originally targets for his tariffs. China has also restricted rare earth magnet exports to Europe to pressure the European Union to reconsider tariffs on Chinese electric cars. Scrolling down, North America and Europe together buy nearly 40,000 tons of rare earth magnets annually for cars, robots, drones, and other products, almost all of it purchased from China, according to Adamus Intelligence, a firm in Toronto that tracks the industry. Countries outside Asia have been manufacturing fewer than 2,000 tons of rare earth magnets a year, mainly in Germany and Finland. Japanese companies have been making an additional 25,000 tons annually in Japan and Vietnam, primarily for automakers and other customers in Japan and South Korea. China, by contrast, produces more than 200,000 tons of rare earth magnets a year. Many of the magnets go into motors and other devices made in Chinese factories as part of China's vast exports of manufactured goods. This is quite a comprehensive article, as it then describes the different projects that are happening. The VAC Group of Germany, which has been Europe's main rare earth magnet manufacturer, plans to commission a factory in Sumter, South Carolina next month with a capacity of nearly 2,000 tons a year, said Eric Eschen, the company's chief executive. It could nearly double capacity in 18 months, he added. MP Materials is finishing a 1,000-ton factory in Texas. It will initially supply General Motors. MP Materials intends an expansion with a second factory to bring total annual production to 10,000 tons within a few years. A third company, USA Rare Earth, has built a factory in Stillwater, Oklahoma. The factory is expected to be producing at an annual pace of 600 tons at the end of next year and twice that by early 2027, said David Bushi, the company's senior vice president of manufacturing. A fourth company, Novion Magnetics, has built a factory near Austin, Texas. But these are optimistic forecasts, industry executives said. Building a rare earth magnet factory is easier than running one, and it can take as long as 3 years to ramp up fully. Quality standards are exacting and require the work of experienced technicians. One reason China is so far ahead in magnets is its near total control over the processing of ore to extract rare earth minerals. Chinese refineries produce over 99% of the world's supply of 3 kinds of rare earths crucial to making magnets that can resist heat. Many mines in other countries, including the United States, have long shipped their ore to China to be refined. Scrolling down, most of the world's rare earth processing equipment is made by China, which has begun restricting equipment exports. China employs nearly all the world's technicians working in the refineries, and the government has recently barred most of them from leaving the country. Quote, "It's not easy to find technical people outside of China," said Ramon Barua Costa, the chief executive of Aclara Resources, which is building a rare earths mine in Brazil. So in a sense, none of this should be news to listeners of this program. But I think we can call it a kind of confirmation. It is more anecdotal evidence strengthening our general sense of what is happening here. So very interesting from the New York Times. Then the Financial Times reports Europe's first production plant for rare earth magnets opens. Canadian group Neo Performance Materials predicts a 3-fold increase in demand over the next decade. This is by Sebastian Ash and Kana Inagaki in London. It looks like it is Europe's first mass-scale production facility for rare earth magnets. Scrolling down, in an interview, Neo's chief executive Rahim Suleiman said the current demand for rare earth magnets was, quote, incredibly large. Customer motivations are incredibly high to diversify their supply base and to have localized supply chains, he added. But we saw in that New York Times article that China exports 200,000 tons of rare earth magnets a year. Neo's new facility will initially produce 2,000 tons of magnets each year, ultimately reaching 5,000 tons. So you see the gap here between China and the rest of the world. That is the economic side of this situation. Then we have some stories absolutely fascinating from the Daily Star on Myanmar and the rare earths. Myanmar's Kachin State, the new geopolitical flashpoint in China's backyard. And then they talk about how the CIA has been working in Myanmar for decades. This whole other backstory, as you're going to see here. So this is Saeed Ahmed at the Daily Star. Most ordinary Americans would hardly know of Myanmar or Burma, as the U.S. calls it, let alone Kachin. Myanmar's northernmost state, which borders China to the north and east and India to the northwest. Yet this remote region was once a crucial battleground for the Office of Strategic Services, OSS, the predecessor of today's CIA, during the Second World War. Maverick OSS pilots flew countless staring missions from their Manipur base in northeast India, ferrying men and arms to support Allied forces engaged in fierce jungle battles against the Japanese onslaught. A rich CIA history, interestingly, in Myanmar, according to the Daily Star. Then the article describes the current situation in Myanmar with the Kia rebels and the military junta that China supports. It is against this backdrop that the U.S. envoy in Myanmar, Susan Stevenson, visited the Kia-controlled area in August, a significant diplomatic signal given that Washington downgraded relations with Myanmar after the 2021 military coup. So more evidence of interest by the United States in Myanmar. Fascinating article from the Daily Star. Continuing on, the South China Morning Post, why plans by India and the U.S. to tap Myanmar's rare earths are fraught with risks. And so the South China Morning Post pointing out that if India and the U.S. are trying to get involved in Myanmar, that this could potentially create pushback by China. Super interesting there. So all sorts of developments going on here. Now, just finally, I had to point out these two stories from the South China Morning Post that caught my eye, and make of it what you will. But it kind of sounds like a science fiction pulp from the 1950s, like a Robert Heinlein or Isaac Asimov or whoever the author might be. China is killing the race for critical minerals with the largest antenna on Earth. Chinese-built high-powered devices 5 times bigger than New York City and leads the global search for lithium, cobalt, and rare earths. So this is Stephen Chen at the South China Morning Post. Hidden within the granite wilderness of central China lies an antenna so vast it dwarfs New York City 5 times over. A 500-kilowatt electromagnetic leviathan originally built to whisper to submarines. Now it is broadcasting China's dominance in the global scramble for critical minerals. As nations race to secure lithium, cobalt, and rare earths for green tech supremacy, Chinese geologists are deploying this monster and its cousins to detect ore and energy resources buried kilometers deep. The researchers' world-leading electromagnetic arsenal, systematically revealed for the first time in a China Geological Survey study published in the peer-reviewed journal Geophysical and Geochemical Exploration in August, leaves competitors in the dust. So, apparently this antenna is being reported by Geophysical and Geochemical Exploration, a peer-reviewed journal. Every ultra-high-powered system exceeding 100 kilowatts operates in China, while the most potent American tool manages a mere 30 kilowatts. So you do see a sort of bias here, comparing it to New York City, comparing the American antenna to the Chinese antenna. But nevertheless, a head-turning story. Quote, the development of these systems marks China's world-leading position on electromagnetic exploration theory and technology, wrote the team of authors led by senior engineer Chen Wei with the CGS Development and Research Center in Beijing. As surface-level deposits have been exhausted, the search has moved deeper into what geologists now call the second mineral space, between 500 and 2,000 meters underground. Geologists believe that most mineral resources on our planet have remained untapped because the continental crust can be as thick as 70 kilometers, and human mining activities at present have barely scratched the surface. At these depths, signals from ore bodies are faint, masked by cultural noise from power lines, urban infrastructure, and mining operations. China has responded by redefining the scale of electromagnetic exploration. By dramatically increasing transmitter power to over 100 kilowatts, Chinese scientists are amplifying the signals sent into the Earth, effectively drowning out interference and penetrating deeper than ever before. So, a wild story out of the South China Morning Post, and then we had another one posted yesterday. China unveils largest known radiation-proof robot for nuclear fusion power plant. Giant main arm of robotic system shown to handle payload of 60 tons with exceptional precision, bridging goal of, quote, artificial sun closer. Now, again, I read these headlines and I thought to myself, what on earth am I reading? And this is by Danny Pang in Beijing. China has built and tested a giant robot that could carry the equivalent of 10 African elephants to perform maintenance work on future fusion reactors, bringing the country closer to its decade-long goal of building an artificial sun. So it's getting pretty wild out there. We have record gold prices. We have rare earths as a major issue. And there is more. So lots to look forward to this episode. If you want to find us online, you can find us at northernminer.com. You can find us on X at northernminer. You can find us on Instagram at The Northern Miner, and on Facebook, LinkedIn, and YouTube, where we also host these podcasts, and wherever podcasts are available, including Spotify, SoundCloud, and Apple Podcasts. And with that, let's turn to this week's sponsor, Major Drilling, for this week's Spotlight. Joining us today, I'm very pleased to welcome back to the Northern Miner podcast for this week's Spotlight, Marc Landry, Chief Technology Officer at Major Drilling, and Patricia Frisch, GeoSolutions Services Manager at Major Drilling. Marc, Patricia, welcome to the show.
Great to be here.
Thank you.
It's great to have you. And Marc, I remember a year ago, we were talking about the new developments at Major Drilling. There was the core initiative. I imagine a lot has happened in the last year. Could you give us an update about what is new at Major Drilling?
Yeah, for sure. Lots have happened in the last year since we invested in our partners with Core Geosystems and DGI Geoscience. We've been able to bring new value-added services to our customers, quite a few customers. We have also engaged in developing a new system, a new tool, which now permits our customers to image the rock, the core samples, right at the drill. And these units that we have now then feeds the Core Geosystems AI platform that automates and brings quality and timeliness to logging the rock. And these systems are built from our team in Australia, our development R&D folks there. So we're excited to bring that to our customers right now. So it's been a very, very eventful year. Lots of gone on, and we're engaging with quite a number of customers right now as we're introducing all of these new services. And she's joined us quite a few months ago, and she brings a wealth of experience having worked for senior mining customers and brings a very good perspective when we meet with customers so that we can articulate and convey the benefits and value of our GeoSolutions offering to our customers. So she's been a great member of the team here.
I'm really excited to be here. As we look at Core and DGI and Major Drilling, just putting AI at the forefront was something that it feels really new in the industry. And there's just an unlimited amount of opportunity with AI to leverage all the tools in geology. And working with Major Drilling is really important, I think, to get in front of customers with an AI offering. We've been working with G Mining Ventures. We went from back of the envelope sketch on being able to put together a drill site image unit to a full production tool that's in the field now. And we've had just such interesting conversations with our clients. They're sitting on another continent, validating their drilling, their geologic models, and really using this AI as a junior employee in their team. And it's really just been exciting to see. And we put a little case study together on that.
Okay, excellent. So ultimately, are you telling me, Marc and Patty, the imaging has become better and more real time? And in a sense, the knowledge that the people out in the field have is far better and it's being uploaded almost immediately. There's less of a lag, so to speak. Is that a good description?
That's absolutely right. And that's a great question, too, because we have a lot of systems in the AI space that produce a lot of information, and it takes weeks to months to harvest the data and then work through it. And at the end, you still don't have a rock code or an alteration code. So what we've been able to do in this partnership is devise a drill site imaging unit that will take the rock immediately after it's placed in the box and upload it via a Starlink connection. And so from the jungles of Brazil, they can see 24 hours a day at any time, anywhere in the world with an internet connection, what is going on. And so the clients are absolutely loving it. This G Mining team is validating their geologic models in real time, monitoring the drilling and making sure that they're piercing the target. They're doing some delineation work. And so this will help them pierce the target, get through the target, define the boundaries of the target, and then move on to the next hole faster and with more confidence. So instead of driving 20 kilometers out to the rig, boxing and unboxing various cases, chunks of core and trying to figure out the sequence of drilling and figuring out where we are in the ore body, whether that's on rock type or alteration zoning or whatever, the team are able to see a continuous hole from a cloud platform, a software as a service platform, instantaneously. And it's been a huge benefit to them. And we're really pleased. We're actually deploying a second unit with that client. They're so happy with it.
What we've continued to embrace and to make part of our strategy is that we truly are a data company, right? So, our drilling activity, which is the core piece of our business, permits us to really extract and leverage the data that we can unlock when we bring the core out of the hole. With DGI, we can send instrumentation when we bundle these services with our drilling activities so that we can have our customers' information bring richer, more detailed information so that can complement their modeling. And then at the same time, while we have the rock, we're able to streamline their process. And by automating the first pieces of logging, it brings a lot of efficiency from our customers, which a lot of mining companies right now are seeking, right? How can we, like Patty said, shorten that geological modeling process? And how can we find ways to bring efficiencies in our customers' process, right? Saving them time and resources at the same time.
Indeed, it's not a cheap business in a sense, the mining business. And there is an emphasis on maximizing the value of every meter that is drilled. So, Patty, what kind of innovations are you working on that are helping to streamline the whole drilling process for your clients?
One of the really cool things that we're working on is the Rock 5 system, which is a measure well drilling tool that's on our rigs. And we have 100 of those deployed across all of our branches for our clients. And it does a couple of things, but one is that it provides a dashboard for our drilling teams that runs in real time to create optimized parameters. So the drillers can see how they need to set the gauges. And I'll just say that I'm not a driller. I'm definitely a geologist, but I do love data and I'm quite familiar with that. So the teams are able to optimize their drilling parameters. They get real-time feedback. They get higher production. So it talks back to them and gives them parameters for highest penetration rate. And so that's super nice for the drilling team. But the thing that I love about it as a geologist is that we're able to harvest that data. And so we've been working with our core Geosystems partners and bringing our measure well drilling data into the core platform so that we have drilling data downhole. Now, I've done a small project where I've looked at drilling data downhole, and one of the things that we were able to do, even with some primitive data, was to validate colluvium levels, layers, and depths, because the drilling penetration rates change so drastically when you go from colluvium to hard rock. Another thing that we were able to see in the drilling data were fault intercepts. So we had a fault system that was about 20 meters wide that you could see from air photos from space. And we're trying to pinpoint both sides of that. And RC, clearly you can't pinpoint that. And sometimes the drilling was so difficult and the rock coming out was so broken that it was hard to pinpoint, but we could see those intercepts in the drilling data. And then the last thing that I think is really exciting for geology using measure well drilling data is that you can proxy hardness. And I know a lot of mines, and especially in production, will have some sort of a blast index or a hardness map for the production team to optimize their powder. And so this is another really cool tool that we can use to kind of maximize cost savings in blasting and also get a lot more geologic information. Being on the core platform also means that it takes advantage of all the APIs that core has native and those connections to geologic databases and geologic modeling software. And so there's an easy export and easy visualization component to that, which is really powerful. I love a good spreadsheet, but if you can see something in 3D, that's even better. And so we have that capability now.
Okay, very interesting. And so as we start to wrap up here, Marc, partnership is a pretty major theme at Major Drilling. Could you summarize some of the partnerships and some of the challenges and some of the successes at the company?
You're right. I mean, we work with quite a number of mining partners right now that are helping us test out and deploy and develop all of these solutions. Right now, we're working with a few that are looking what's next, right, with our developments, our innovations. So we're working right now at seeing what other sensors that we can add to our drill site imaging unit to keep adding quality sets of information to help the whole process for geological modeling.
The partnership with Core and DGI at Major Drilling has really done a huge amount for geologists. It's taking rock and shortening the whole value chain. So if you think of rock as just the starting point for all the data that goes into geologic models that are underpinning the reserve and resource declarations, we have taken this partnership when we're providing tremendous value to our clients and being able to offer an all-in-one solution for faster, more accurate, efficient ore body knowledge that drives the value chain and shortens the timeline between drilling and resource declaration.
Okay, excellent. So there's the drill side imaging unit, there's the Rock 5, there's the DGI Geoscience and Core Geosystems partnership. As we wrap up here, Marc, if people want to learn more, what should they do? How should they get in contact with Major Drilling? What should they do to move forward?
Go to our website, majordrilling.com, go in the GeoSolutions section. You'll be able to see our latest case study, which Patty mentioned that we have just published. And it basically brings to the readers what the value is of the solution that we're deploying with the drill site imaging unit. And also you'll be able to learn about Rock 5 and how we're basically forging ahead to develop measure while drilling solutions.
Okay, excellent. So it's majordrilling.com. Marc Landry, Chief Technology Officer at Major Drilling, and Patricia Frisch, GeoSolutions Services Manager at Major Drilling. Thank you for joining us and telling us all that you're working on at the company.
Thanks so much.
Great to talk to you.
And thank you once again to Major Drilling for sponsoring this week's episode of the Northern Miner Podcast. If you want to learn more, visit majordrilling.com. And turning to the website, I mean, so many huge headlines here. Barrick hits 13-year high on game-changing discovery. This is by a staff writer at mining.com. Barrick Mining rallied to its highest in 13 years, and it rallied pretty quickly when you look at the chart, as it builds off the momentum of a game-changing gold find in Nevada, as well as the broader strength of the precious metals market. Behind the recent rally was a new study on the company's 4 Mile project in Nevada that showed the potential to produce as much as 750,000 ounces of gold annually. Plans are in place to start underground mine development in 2026. In a press release dated September 16th, Barrick CEO Marc Bristow called it a, quote, multi-generational project that has the chance to become the largest and highest-grade gold discovery of the century. The market reacted positively to the news, with Barrick's share price rising about 23% since that news release. And a couple of headlines here on Anglo Tech, as it's being called. Tech deal with Anglo faces indigenous challenge on smelter plan. It's Bloomberg News via mining.com. And we have another headline. Canada will take close look at the Tech Anglo deal, says finance minister. So the deal coming under scrutiny here from multiple angles. Continuing on, U.S. reevaluating $2.3 billion loan for Thacker Pass lithium mine in Nevada. This is Bloomberg News via mining.com. The Trump administration is reevaluating a $2.3 billion loan approved by President Joe Biden for the development of a Nevada lithium deposit, according to people familiar with the matter who asked not to be named discussing internal business. The record-high loan to Lithium Americas, finalized in 2024, would have provided most of the capital for the construction of a processing plant adjacent to the company's Thacker Pass mine on one of the country's largest lithium deposits. So more reviews. This time the U.S. on Lithium Americas and Thacker Pass. We have a big update on deep-sea mining. Oceans Protection Law to tighten squeeze on seabed miners. This is Cecilia Jamasmy at mining.com. A newly ratified treaty to safeguard life at sea is expected to intensify opposition to deep-sea mining at a United Nations Climate Summit this week in New York, running alongside the Leaders' General Assembly. The High Seas Treaty, officially known as the Biodiversity Beyond National Jurisdiction Agreement, will enter into force in January next year. This was made possible after Morocco became the 60th nation to ratify it on Friday, crossing the threshold required for UN treaties. 2 decades in the making, the pact allows the creation of vast conservation zones in international waters with the goal of protecting 30% of the ocean and halting biodiversity loss by 2030. Although the treaty does not mention mining directly, it requires governments to cooperate with agencies such as the Jamaica-based International Seabed Authority, which has yet to approve commercial mining in international waters. Environmentalists welcome the breakthrough. Quote, "This is a conservation opportunity that happens once in a generation, if that." Lisa Spear, director of the International Oceans Program at the Natural Resource Defense Council, said in a statement. WWF International Director General Kirsten Schucht called it a, quote, "turning point for 2/3 of the world's ocean that lie beyond national jurisdiction." So it continues to be a major point of contention, deep-sea mining. Another headline, India signs deep-sea mining exploration deal with International Seabed Authority. This is Reuters via mining.com. India has signed a 15-year contract with the International Seabed Authority for exclusive rights to explore polymetallic sulfides in the Indian Ocean, the government said on Saturday. Continuing on, this is based on a report from the Financial Times. This is by a staff writer at mining.com. BHP eyes Geraldine Slattery for CEO role, FT reports. BHP Group could appoint Geraldine Slattery, president of its Australia operations, as the company's first female chief executive in its 140-year history, the Financial Times reported on Friday. If appointed, Slattery would join a short list of women to lead a major global mining company. One of the most notable was Cynthia Carroll, who became the first woman to head Anglo American in 2007, serving until 2012. Very interesting there. Now we have another development from Barrick, this time in Mali. Mali appeals order to free detained Barrick staff, according to a report. It's by a staff writer at mining.com. Malian prosecutors have appealed a judge's order to release 4 employees of Barrick Mining on bail, extending the legal uncertainty around the Canadian miners' operations in the country, Bloomberg reported on Thursday. The employees, including a regional manager detained late last year, will remain in jail until the Court of Appeal reviews the prosecution's case, according to people familiar with the matter. The judge had set bail at $90 million, an unusually high sum, one of the people said. And also in Mali announces new mining deals under revised code. This is Reuters via mining.com. Mali has approved 7 agreements granting the state more revenue from international and local mining companies in the latest push by the military government to extract more income from the sector. Scrolling down, the agreements apply to gold mines including the Sadiola project, operated by an Allied Gold subsidiary, B2 Gold's Fekola mine, and Resolute Mining's site at Syama, as well as Ganfang's Buguni project. Mali's military rulers introduced a new mining code in 2023, increasing royalties to 10% from 6.5%, while expanding state and local ownership of mines to at least 35% from 20%. Continuing on, Congo will not auction mineral resources to the United States, President says. This is Reuters via mining.com. Democratic Republic of Congo President Felix Tshisekedi said on Monday that a U.S.-mediated peace deal signed with Rwanda in June has not calmed fighting in eastern Congo, though he thanked President Donald Trump for attempting to end the conflict. Scrolling down, the Trump administration has said it is eager to end fighting that has killed thousands this year and attract billions of dollars of Western investment to a region rich in tantalum, gold, cobalt, copper, and lithium. The deadline to implement part of the U.S. deal is this month. Despite his support for U.S. mediation, it, quote, does not mean that we will auction our mineral resources, Tshisekedi told reporters in New York. Quote, we will, as part of this partnership, be working in the development of the mining sectors, developing the value chain, developing infrastructure with a particular emphasis on energy. Tshisekedi said the country had signed a strategic partnership with China. Quote, today we are negotiating a similar partnership with the USA, and we hope that we will complete it, he said. So quite interesting. And another headline out of the Congo to replace cobalt export ban with quotas from October 16th. That's Reuters via mining.com. And going south to Zambia. U.S. invests $1.4 million in Zambian mine expansion to rival China. It's by Cecilia Jamasmi at mining.com. The U.S. Trade and Development Agency awarded on Thursday a $1.4 million grant to Metalex Africa, a subsidiary of U.S.-based Metalex Commodities, to finance a feasibility study for expanding the company's Kazozu mine in Zambia's northwestern province. The study will assess whether the mine can produce up to 25,000 additional metric tons of copper and cobalt concentrates annually. It seems like they are putting their toe in the water there with the $1.4 million investment. A couple more headlines here. Codelco to produce less than thought at top mine. It's Bloomberg News via mining.com. And according to El Mercurio, a newspaper in Chile, Codelco said its biggest mine, El Teniente, will take longer to return to full production than originally forecast after a deadly tunnel collapse in July. This is due to the company's caution in following safety protocols following the tunnel collapse that left 6 dead, the newspaper said, citing company chairman Maximo Pacheco. As well in South America, BHP Lundin Mining bet $400 million on Argentina Copper Hub. And finally, we have a story from Amanda Stutt on uranium. We're in Project Manhattan 2.0, uranium CEO says. This week, when U.S. Energy Secretary Chris Wright said the U.S. should look to boost its strategic uranium reserve to buffer against Russian supplies and increase confidence in the long-term prospects of nuclear power generation, it shone a spotlight on the impending uranium supply deficit. And the quote is from Eagle Energy Metals CEO Marc Mukija, who talked to mining.com in an interview. Quote, AI cannot be decoupled from national defense. Power is the bottleneck. We're in Project Manhattan 2.0. We need to get as much power generation as possible, and we're excited to be part of the Western response to all of that because we need to make sure that the United States has uranium and fuel for their reactors. The project meets national policy initiatives of a resource that the country needs. So fascinating developments here. There is definitely something happening out there. The mining narrative has never been more intense, at least in the last 15 years that I have been following it. So those are your news stories. Now, let's take a look at metal prices. And turning to metal prices, let's take a quick look at the bond market for context. The U.S. 10-year bond is yielding 4.14%. That is 0.1% higher than last week. The UK 10-year gilt is yielding 4.71%. That is 0.06% higher than last week. Italy's 10-year bond is yielding 3.57%. That is 0.06% higher than last week. And I'm adding France to the mix so that we have all of the major bond markets here. France's 10-year bond is yielding 3.56%. Germany's 10-year Bund is yielding 2.74%, so that is 0.04% higher than last week. And the Japanese 10-year bond is yielding 1.65%, that is 0.05% higher than last week. And China's 10-year bond is yielding 1.88%, that is down 0.01% on the week. And turning to precious metals, gold is trading at $3,823.40 per ounce. That is $87 higher than last week. So big move in gold. Silver is trading at $44.20 per ounce. That is $1.02 higher than last week. Platinum is trading at $1,424.10 per ounce. That is $11 higher than last week. And palladium is trading at $1,197 even. That is $5 lower than last week. Turning to industrial metals, copper is trading at $4.58 per pound. That is 8 cents lower than last week. Iron ore is trading at $105.49 per metric ton. That is 6 cents higher than last week. Aluminum is trading at $1.20 per pound. That is 3 cents lower than last week. Lead is unchanged at 91 cents per pound. Nickel is slightly lower at $6.91 per pound. That is 7 cents lower than last week. Tin is trading at $15.50 per pound. That is 36 cents lower than last week. Cobalt is trading at $15.67 per pound. That is 55 cents higher than last week. And lithium is trading at $10.38 per kilogram. That is 19 cents higher than last week. Uranium is trading at $76.90 per pound. That is $1.20 higher than last week. And finally, zinc is trading at $1.32 per pound. That is 3 cents lower than last week. So zooming out, the big show in the precious metals, a big week with industrial metals mixed, edging sideways. And those are your metal prices. Coming up, I'm very pleased to welcome back to the show Cam Currie, Senior Investment Advisor at Canaccord Genuity, Currie Metals and Mining Group. We discuss the gold stocks, we discuss the silver stocks, we discuss metals, mining, and the big macro issues going on across the world. It's a very interesting interview, and you get some insights into how Cam is thinking and where we are in this gold and silver bull market. It's a wonderful interview. I hope you enjoy it, and I will see you on the other side. Joining us today, I'm very pleased to welcome back to the Northern Miner podcast, Cam Currie, Senior Investment Advisor at Canaccord Genuity, Currie Metals and Mining Group. Cam, it's great to have you back.
Thank you for having me back, Adrian.
So much of what we've discussed here, Cam, has seemed prescient as far as where we are now. We've been discussing the gold stocks. We've been discussing the investment thesis for gold, extending all the way out to the BRICS and problems with the dollar, debt, bond markets. And here we are in 2025. It's looking pretty good as far as the thesis is concerned. What do you think?
Absolutely. Going back 3 years, we talked about this, I think, in early interviews, talking about, what is driving the gold market and why it was so stealth. I mean, it was only, 15 months ago, gold was 2,000 with no fanfare whatsoever. Quite honestly, even today, in the North American narrative, so to speak, people are still talking about Palantir, Oracle jumping $85 on the AI deal, sales projections, that is. And the fanfare and the narrative towards gold is largely under the radar screen. Yet we've had a significant appreciation in our gold stocks here for the last, 8 months specifically. I've been asked this many, many times, where do you think we're going on this? And have we missed it? And we have absolutely not missed it. We're talking about a tectonic shift in gold as a reserve currency asset. And it is largely being unrecognized in the US media for that, because again, the US dollar is the reserve currency of the world, and that's their belief. But as I said before, I think on a previous interview, gold surpassed the euro as the reserve currency status among central banks in the world, second to the US dollar. And that's not going to stop. I mean, we have $300 trillion of global debt. Debt is becoming worrisome. If you look at long rates around the world, and especially in the G7 countries, they've been backing up because interest rates are becoming a function of risk. The debt markets are getting more risky, deficits are increasing, and people are now looking at fiat currencies in a greater risk profile. So once again, I've said this many times, gold is the only currency in the world that has no political attachment, no debt obligation, and no printing press. And the central banks around the world in the last 2 years bought over 2,000 tons of gold. And that's what's registered. No, it's probably significantly greater than that. Because what they're doing is they're giving back the IOUs of the US dollar, which is the fiat currencies, and they want the real currency back, which is gold. So that's where we sit today.
It is quite interesting, as you point out and have pointed out in the past, but even still, the narrative has not quite gotten there yet, has it? It's not like we open up, CNBC every morning and see a big headline on the gold stocks. We're not even seeing that many gold headlines or silver headlines. And so one imagines that this is part of the reason you would think this is still bullish. Is that correct?
Absolutely. But you are seeing more and more foundations of validating gold as an asset class, whereas 6 months ago, people were still referring to it almost like a pet rock or laughing at it in the financial media. But, for example, this past week, Morgan Stanley came out and their chief investment officer came out with a revision in his balance of stock bond portfolio, which was 60% equity, 40% bond. And they just revised it to 60-20-20. And it's 60% equities, 20% bonds, and 20% gold, which is a significant shift. And then after the Fed's decision on interest rates, Jeffrey Gundlach, who is the king of bonds, he was being interviewed, and he made the comment that you could have upwards of 25% of your assets in gold. And you have, of course, people like Ray Dalio, who's talking about this new world order, et cetera. And he's been talking about if you don't own gold, you don't know the history of fiat currencies. There's multiple foundations. And so it's almost like, as I gave an analogy years ago, it's like being in BC Stadium, a big, 70,000 person stadium. And the game's been going on in the field down below. And it's been NVIDIA, Tesla, and all these, Apple, and everyone's focused on that. And up in the nosebleed section, there's 5 people trying to get the wave going. And that's the gold market. Well, now we have 50 people. Now we have 70 people. And now people are looking up going, wait a minute, something's going on over there. We should take a look. And so it's still not on the field. And so I think we're in a situation right now that the narrative shift is going to happen. And, I think that quite honestly, the shift is going to come when the US dollar does break. And we're very close to breaking a 14-year upward trend in the US dollar. And that, I think, will be one of the major catalysts to validate the narrative as to why you have to have gold in your portfolio.
Well, speaking of tectonic shifts, I mean, that really is what you're describing there, a tectonic shift when all of a sudden, 20% starts becoming a normal allocation. I mean, we saw last week Ray Dalio discussing 10 to 15%. I was commenting on the show, like, this is not typical. Usually, and we don't need to go that far back. It was like 2 years ago, even, where if you said 10%, you were bordering on extreme, right? And now it's quite something for those of us that have been kind of paying attention here for a few years, don't you think?
Oh, absolutely. And just understand something here. If you look at family offices in the United States, half of 1% of their portfolios are in gold right now. Half of 1%. So you start thinking about this, and then you start looking at the physical gold market and the actual physical supply of gold. Production goes up by about 2% max a year. And we know what central banks are doing. And they're buying gold and they're not parting with it. I think I mentioned this in a previous interview. You look at India, for example, buys the oil from Russia. And since the invasion of Ukraine, their purchases of Russian oil went up by 33x. And they're using gold as collateral in transacting in their currencies outside the SWIFT US dollar fiat currency system. And as we all saw 2 weeks ago, President Xi hosted the BRICS nations, and Modi was there, Putin was there, Kim Jong-un. And what was really unnerving in my view is the comment from President Xi saying about the new world order. And then 2 days later, of course, they had the military parade. And that military parade created a lot of new technologies in the military arsenal. But the fact that Modi is at the BRICS nation, and as we all know, he and Trump have had a little bit of a conflict over these tariff issues and that, they're not going to stop doing the transactions and buying gold as collateral, because that's just the direction the central banks are going. Because, of course, the tariff risk and the uncertainty of Trump at any given moment, why would you expose yourself to over ownership of US dollars when you could be penalized with your US dollar ownerships like Russia was, deservedly, of course, in Russia's case?
Yeah, it's quite interesting. I mean, Jeffrey Christian describes this as a bull market in real things, which I thought was a nice way of putting it, because it does seem, again, 10 or 15 years ago, to talk about paper assets versus hard assets. In a sense, in terms of narrative, it was kind of more seen as a, quote unquote, gold bug narrative. Whereas today, it does feel like there is a shift where all of a sudden gold is now seen to a certain degree, when you think of these large scale allocations, as the price of preserving your wealth to a certain degree. What do you think of that?
Oh, absolutely. And what you're seeing more and more, and again, unless you look for it, the media in North America doesn't really talk about it, but you look at the physical demand for gold out of China. I mean, the new generation of Chinese youth love gold. They love it as an asset class. India, it's been a part of their culture for a long time. The Middle East, they want hard assets. And that's on the consumer side. But really, most importantly, Adrian, I think it's important to really focus this. Gold is the second reserve currency of the world, second to the US dollar. And US has $37 trillion in debt. And Doge was not successful. Deficit's going to increase. And the trend towards gold as a reserve currency, when a central bank makes a move like this, it's like a freighter changing direction. It keeps on going the same direction for a long period of time. they've been buying gold significantly since 2012. And going back to the financial crisis, when the banks failed, government backed the banks. And I talked about this before again, that when the banks failed, the US played their cards. They basically survived the banks and they left everyone else to deal with collateral damage. So they played the card that they're going to look after America first. Well, now we're in a world where the rest of the world is getting more and more suspect about US debt and US stewardship. And they're going and continue to buy a reserve currency that's independent and outside the US dollar. And that trend is not going to stop.
It is interesting. And you bring up the debt markets. I mean, they do seem to be flashing, perhaps not a red signal, but perhaps not a yellow flashing signal either, maybe more of a yellow to orange signal. I mean, when you look at the debt markets and say, the US 10-year doesn't look bad, but I mean, Powell comes out to say we're lowering interest rates and then the US 10-year yield goes up. You see what's going on in Japan in the last, just recently. What is your sense of the debt markets and say of the bond market? Is that the main culprit here?
Well, going back to the G7 countries in the first place, they're all debtor nations. And you look what's happening right now in the British market and in the French bond market as well. I mean, there's jitters. And of course, Japan, but Japan's a controlled market with the Kirusutsu, so the ownership of their assets and instruments. But the G7 countries have one thing in common. That is, they've basically grown and leveraged off of debt. And the debt markets are excessive, like we talked about. And as you pointed out, long rates are going up in these countries. Why is that? And I've always gone back to the basic economics 101. Interest rates are also a function of risk. So is the rest of the world now pricing in greater risk in long-term bonds? And I would say yes. And if that's the case, where are they going? Well, they're telling you where they're going. They're buying a tangible, hard currency of gold. And once again, the rest of the world's doing this, but we don't hear the narrative here because, again, all you hear about is AI. You hear about, like Meta, for example, has 400 ETFs that have it as a top 5 holding. So you have all this money spraying into the megas and these AI stocks and that. And yet you look at a lot of, I guess, standard economic indicator companies and the stocks have not performed. So I think there's a greater risk curve happening. Look at unemployment. Unemployment's starting to go up. Housing prices are just starting to roll over the United States. So there's a lot of elements of risk coming into the system. And yet, when you listen to people on CNBC talking about the stock market, they don't see anything that's going to derail it because they think that, we're in this sweet spot. And I can identify outside of the wars themselves. You look at what's going on in the debt market. You look at what's going on in global trade. Look at tariffs and the uncertainties going forward. And I find it very surprising that the narrative right now is still that this bull market's fully intact and there's nothing that's going to derail it, because I see many, many things that are going to.
Indeed. And just to almost hammer home the point here, it's like, traditionally the risk-off trade was the bond market, but it's like now it's not really seen as so much the safety trade anymore. And if bonds aren't the safety trade, then what is? Right? I mean, where do you go? And even with gold and silver, I mean, silver hasn't even hit a new all-time high. I mean, the rest of the metals are looking pretty darn attractive, frankly, from a valuation perspective. I mean, do you think that's next? And do you see the metals as a kind of safety trade of sorts?
Well, silver is a catch-up trade, no question. And when silver starts, which is what's been happening recently, that's confirmation that where we are in the stage of this bull market. The fact it's lagged so much is a telltale of past cycles to suggest we're still early. And, I know people are looking at some of these stocks, like Agnico Eagle from $65 to $212, Kinross from $750 to $31. They think, oh, we've missed this. But you have to understand, there's only 10 senior mining companies, maybe 10 or 12 mid-tiers. There's very, very, very few companies. And so when the funds and the ETFs start spraying into these underlying stocks, there's going to be a significant amount of money flows coming into them. And put that aside, just look at the fundamentals. Most of these companies now are debt-free. And you start looking at how profitable these companies are. Gold's at $3,700 an ounce or $3,600. And the ASICs, all-in sustaining costs, are $1,600, $1,700. So you're looking at $2,000 a margin. And for every $500 move in gold, that $500 goes to the bottom line. So what's going to happen on CNBC when all of a sudden, this time next year, wherever gold is, they start showing percentage changes in profitability of gold companies that are debt-free and they're increasing dividends and buying back their stock. And there's only 10 seniors and 10 intermediates. Then you start hearing the old adage, what a gold mine, the gold standard is gold, and all the narratives of gold will become trending. And people think, $3,600 gold has gone way too far. Well, what were people thinking about Bitcoin at 5,000, 10,000? And I'm not trying to parallel the two by any shape or form, but psychologies of bull markets early on always are doubted and questioned. And I would say that that's the narrative theme right now. But we're starting to get that little trip switch happening where people are going, wait a second here. There's some substance and some validity. Case in point, Morgan coming out with that comment, and Jeffrey Gundlach and Ray Dalio, who stayed true to this. So we're in a very, very, very interesting chapter. And as I mentioned earlier, the US dollar is showing the signs of weakness. And if the US dollar starts to break, how are you going to attract money to come into the US debt market with a declining currency?
That is a key question, isn't it? Because that does seem to be part of what's going on here, in a sense. And even with European debt markets, the euro's had quite a run, at least when I look at my euro to Canadian conversion here. And so, will it keep going higher? Now, in terms of, say, the metals and the metal stocks or mining stocks, how are you looking at, say, the gold stocks versus other metals? And maybe I'm thinking industrial metals, for example. In a sense, the gold stocks have had quite a move. Where is your focus right now as an investor? Like, if you're putting new money to work, are you going to the gold stocks, or are you looking at things like copper, which is still below $5 a pound?
Well, we have a very big position in gold. So, that's 95% of our weighting. And as I say to clients right now, it's like being on a sailboat with your spinnaker out. Just sit back, let it take you. Because it's easy to think you can just take some profits and roll back in. Copper, I love copper long term. I'm just cautious on the economic front moving forward. But supply of copper and new mines coming on is a huge problem. And I think what's changed my mind on the copper side, despite recession risks that still no one really believes in, but if we do get a recession, AI and build out of the grid and data storage requires a lot of copper. Data storage facilities, 6% of the cost of a data storage facility is in copper. So all this AI, ChatGPT, for example, uses 10 times more energy than a Google search. All that means energy, which means transfer of energy, which is copper. And there's no big copper deposits being found. The most recent one is the Vicuña district of the Lundin Group, but it'll be years until that comes into production. So I'm very bullish long-term on copper because it's just a supply side issue.
Yeah. And what about metals like, say, nickel and lithium? Do you think that's being, as they say, too clever by half, where let's say you feel like you missed the gold move as an investor and you say, I know I'll go with what's still cheap, but then sometimes those kind of stocks don't perform, is often what happens when you take that kind of approach. How do you feel about, some of the more unfavored industrial metals?
Well, nickel had a little bit of a tectonic shift when the Chinese went into Indonesia and started mining this nickel saprolites. And so nickel prices dropped off significantly. Now, it's an environmental nightmare what they're doing there. So over time, I think there'll be some changes. So I think there will be a rebound in nickel. And nickel, obviously, is a very important metal as a critical mineral. Lithium, for the first time, actually, I've just started accumulating a very big position in my tier one lithium company, because I think lithium is an AI and data storage story. I think it was left for dead. A lot of funds lost a lot of money. It went to 80,000 per ton in the last cycle, got way overpriced. Now it's around 17, 18. I think the Chinese have an influence on the pricing of it. But EV, we look at the car side of it, but you have to look at data storage and AI. You need energy storage. So these energy storage facilities that are going to be required all are going to be lithium batteries. And I think that is going to be a big driver on lithium. And I think lithium markets have bottomed. I think some big smart funds now are starting to pay attention to it, but nobody's long. The one particular company I'm involved with, there's 0 institutions in it. Whereas the last cycle, everyone was there. And I love looking at sectors where price action is getting more positive and yet nobody's paying attention. 2.5 years ago in the gold market, that's exactly what it was and where we are now. It's really difficult buying when no one's paying attention, but that's the best time to buy stocks.
So, as we start to wrap up here, Cam, I want to talk about, say, silver. Is there anything to add with silver, say, in contrast to gold? There aren't as many companies that mine for silver. What is your sense of the silver market right now?
Well, I'm very bullish on silver. Silver is a leverage play on gold. And now we're finally starting to get some momentum in silver, but I don't even know what price point it's going to go to because it will get the investment theme. I've got a kilo of silver sitting on my desk every day. I just hold it in my hand. I just think like it's an asset class that I'm never going to part with. And I think the silver bugs, especially American silver bugs, when they come into the market, it will be very aggressive on the price action. The problem with silver is it's pretty much a byproduct. There's very few primary silver producers. I was actually just looking at a chart and some of the companies and largest primary silver producers like 18 million ounces, 15 million ounces, 16 million ounces a year, which is not a lot of ounces relative to some of the gold mines of 1 million ounce producers, right? There are very few. And, again, I don't want to give a plug to one of my favorite silver companies, but, Vizsla Silver is advancing a project that will, I put it in the realm of probably the top silver producing asset, upwards around 20 million ounces as a primary silver. And an asset like that doesn't sit without being recognized by the market.
Listeners always appreciate a little tip like that, not financial advice, of course. Now, sometimes there is a concern, and we've discussed this before, of this notion that when we approach a recession, basically the baby gets thrown out with the bathwater. And in some respects, one could imagine that even happening to gold stocks. Do you think that's going to happen this time around? Or how are you approaching how to treat, the mining stocks should we enter into recession?
That's one of the things. Market corrections are market corrections. Liquidity. There's always risk to the downside if there's a serious market correction. But I'll go back, and I think I mentioned in a previous interview, was the interview with Marc from Agnico Eagle about 1.5 years ago. And this is really important for the listener. Amar Agnico, at the time it was around $160 a share, now $212 a share. But he was being interviewed, and some of the big generalist funds in the States, this is what they were telling him. They're keeping an eye on gold, they're keeping an eye on Agnico Eagle, and they're getting more concerned. They're getting more concerned about deficits, valuations in U.S. equities, but they're playing the trend that they have to play right now. And keep in mind, this is when Agnico was 160. Now it's 212, and gold now has gone from 2,300 to 3,600. So what they're also saying to him, and this to answer your question, Adrian, is of the last 15 market corrections of 35% on average, 14 of the 15, gold went up by 45%. So these are the big generalist funds saying to him that if there's going to be a market correction, we want to own gold and we want to own you. Well, fast forward from 1.5 years ago, look what the stocks have done. Look what gold's done. This market we're in right now is, in my view, if it wasn't for AI and technology, I'm not sure where the equity markets would fully be right now. But clearly, some smart money is owning Agnico and continue to buy gold because they're seeing greater risk in the marketplace. So the question is, what happens when the U.S. equity market does roll over? I think the foundation of gold and gold stocks as a protective asset, the foundation's in place. And I think when the validation of that starts in the media, that's when I think the U.S. investor will become very aggressive on the gold equities and gold itself.
Very interesting. And just in regard to, say, the metal versus the stocks, do you have a bias, let's say, towards, say, the stocks over the metal right now, say, in regard to, say, gold and silver? Are the stocks where the action is as far as you're concerned?
Oh, absolutely. The other thing, too, is you look at gold price today opposed to last quarter and the quarter before. Wait till these companies start coming out with their percentage profitability increases. Because don't forget, if gold's up $500 or $700, that goes right to the bottom line. So as a percentage change in profitability, think about the impact that has. And I think that will be a very big driver of the narrative in the financial media in the United States towards gold stocks. Because we all watch every day when you see a company that jumps by $20 on the NASDAQ because it beat the street by, 5 cents on earnings. And so the stock jumps significantly. Well, what's going to happen to these gold stocks when all of a sudden they show a 30% or 40% increase in profitability and they're debt free and they're increasing dividends? It will attract a whole universe of investors. And as it sits right now, like I said, Family offices in the United States have 0.5% of their assets in gold and gold equities.
In an indebted world, to have those kind of fundamentals,
Those margins.
yeah, those kind of margins, exactly, like making money.
Adrian, tell me another sector right now that is debt-free, spraying out significant cash flow. The PE multiples are declining because the gold price is going higher, and they're going to start increasing dividend payouts. I mean, you look at some of these companies. I mean, there's been 2 or 3 companies I know of where they had special dividends. One of them paid out $450 million in special dividend, another $650 million in special dividends. The sector's never been in this financial shape before, and it hasn't been validated for where it is today, and that's coming.
And it's a great point you bring up, particularly, frankly, on the valuation side of things with the PEs in particular, because you could say, oh, well, the tech stocks are making money, but you look at the PEs, the valuations, it's a completely different story, isn't it?
Well,
And
even the word E, I mean, look at Palantir, trading at 80 times sales. MicroStrategy is trading at 3 times the book value of its Bitcoin holding. It's not about E at all. That's the narrative. And I think I mentioned, you look at the passive funds, the ETFs spraying into these things. And to go back last Christmas, there was 3 companies added to the QQQ index. One of them was called Axon, which is body cams and tasers. The stock went from $500 to $800. The other one was Palantir, that we all know went up significantly. And the other one was MicroStrategies. And at the time, I think it was trading at 4 times book of its Bitcoin holdings. So those were added to the QQQs, which is the most heavily weighted ETF index in the United States. Now, the average person has no idea when they're actually buying the QQQ, they're spraying their investment dollars into the holdings of the QQQ. So they're buying these stocks at these prices. Crazy.
indeed, from a valuation perspective, it's quite the contrast. And I feel, in a sense, lucky to a certain degree, or I think investors might think of themselves as lucky, thinking that there is actually somewhere, especially when you look at these industrial metals that are at least, they're not, in the stratosphere as the everything bubble runs away with itself here. Just finally, a couple of final questions here for you, Cam. Just on PGMs, platinum and palladium, do you have any big picture thoughts?
The problem with PGMs is you really can't play them on a pure basis because they're a byproduct. I just think there's such a small universe of market compared to the gold, copper, and silver. So I don't really pay attention. I mean, there is a company I'm involved with that has very high PGMs, and believe me, it's very accretive to their numbers, but it's a byproduct. And so it's very difficult to find any PGM pure plays. So I don't really give much thought to it.
And so you keep it simple in terms of, say, your investment thesis for the metals. It's like, you know what, gold and silver look great, copper looks great. Let's keep the main attention there. And then around that, we can kind of build things and see opportunities. Would it be fair to say that's the main show?
Absolutely. I mean, those are the big liquid markets too. They're the narrative, and the other ones are byproducts. It's a funny market because going back to keep it simple, I mean, my thesis has been metals and mining for a long period of time. And for the longest time, everyone was chasing all these technologies and all these build-outs of solar and wind and everything else. But through this whole process, and I think Robert Friedland summed it up. He was being interviewed once, and he was talking about copper. And he says, for example, here we are in this theater, and without copper, we wouldn't have the lights on. You wouldn't be filming me. We wouldn't be broadcasting this through copper wires. Metals are an integral part of the technological buildup that's taking place right now. And eventually, that correlation will be put in place. Because without these metals, I mean, gold, silver, copper, they're conductors. They're very, very important to that. Gold, again, I go back to it as an asset class and as a currency. That's the primary driver there. But silver and copper are driving forces in this new technological world. And there's not a lot of deposits coming down the pipeline. So supply is going to be a big problem. Then you tack on investment demand. And I would surmise in the next 6 months to a year, especially in the gold market, you're going to find narrative that cannot get physical gold. Physical gold is going to become much more difficult to buy. I met with the Tether Group, who just invested in 2 royalty companies to the tune of $1 billion market cap of the royalty companies. And they're the major shareholder. And the head of Tether was telling me that, they own $150 billion worth of treasuries. Every Monday they buy over a ton of gold. And he was saying it's getting more and more difficult to find the physical. And that's now. And as we know about human nature, if you can't have something, you want it. And if all of a sudden the narrative is, well, one thing is the gold price, but two, actually trying to get a handle on physical for your own possession, and it's difficult. What do you think that's going to do to the narrative?
Cam Currie, Senior Investment Advisor at Canaccord Genuity, Currie Metals and Mining Group. Thank you for joining us and sharing your perspective on the metals markets and the mining stocks.
Thank you, Adrian. Appreciate it.
Thank you once again to Major Drilling for sponsoring this week's episode of the Northern Miner Podcast. If you want to learn more, visit majordrilling.com. And thanks once again to Cam Currie for appearing on this week's episode. And thank you, dear listener, for continuing to support this program. If you want to help out the podcast, please leave us a review in the Apple Podcast directory, share it with your friends, and until next week, take care.